There is a persistent assumption in technical analysis that symmetrical patterns yield symmetrical results, that if a price trend pauses in perfect geometric balance, the subsequent move will mirror the past. Traders view the textbook pennant as a half-staff midpoint, assuming the preceding trend exactly equals the following trend. But analyzing 462 empirical formations, geometric symmetry collapses. The classic price target is hit, at best, between 50 and 63% of the time. Relying on that 50-50 coin flip is expensive. Traders relying on a perfect one-to-one continuation frequently overestimate their target yields, holding positions while the momentum completely evaporates. The data shows that the post-breakout trend routinely underperforms the antecedent trend. Upward breakouts actually take about a week longer to resolve, and they do not climb as far as the initial move. To find an actual edge, we have to look past the top-line shape. We need to deconstruct the empirical data, identify the specific structural modifiers that dictate success, and then build a quantitative execution algorithm. Mastering pennants requires discarding textbook dogma. We have to trade based on empirically validated filters. This chart isolates the required pennant morphology. The primary prerequisite is the flagpole, a steep, rapid antecedent price trend. Following that climb, price action must be tightly bounded by two converging trend lines. Crucially, these lines typically slope against the prevailing upward trend. A valid pennant is brief. The average formation lasts only 9 to 11 days. If the price action remains trapped inside those converging lines for more than 3 weeks, the structure degenerates into a symmetrical triangle. Once that threshold is crossed, the specific probabilistic profile of a pennant is entirely invalidated. Time decay destroys this pattern. Its empirical validity is entirely dependent on a rapid and decisive structural resolution. Even when a pennant meets every geometric requirement, the breakout itself can generate a false signal. This chart illustrates a failure known as a throwback. Price breaks out, appearing to confirm the pattern, but immediately reverses. Notice the trajectory: an upward pierce of the trend line, an immediate looping reversal back into the formation, followed by a steep downward collapse. When price ascends immediately after piercing that boundary, the structural logic of the setup is broken. A throwback scenario should trigger an immediate invalidation and a defensive exit. The mathematical drag of these reversals is severe. Throwbacks and pullbacks occur up to 54% of the time, and when they do, they require an average of 2 weeks just to return to the breakout price. Performance plummets as a direct result. Valid pennant breakouts demand clean, unhesitating directional momentum. A throwback represents a critical loss of your probabilistic edge. Price action alone is insufficient. Volume analysis is the mandatory secondary filter for confirming a breakout's validity. Look at this split-screen comparison. The standard expectation during a pennant is a declining volume histogram. However, for upward breakouts in bull markets, the optimal profile is U-shaped, boosting performance 31%. Conversely, downward breakouts in bear markets perform best with a falling volume slope. Those distinct profiles highlight a broader variable, the overarching influence of macroeconomic regimes on your success rate. The data validates a simple rule: trade with the prevailing market current. Go long in a bull market and short in a bear market. Counter-trend trades mathematically underperform. In fact, the most significant anomaly in the entire dataset occurs when aligning pattern direction with a macro downtrend. Pennants in a bear market with downward breakouts exhibited a 0% break-even failure rate. Isolated price action is insufficient. Volume shapes and macro regimes are the required filters that define high-probability setups. Once the macro and volume filters are cleared, we must analyze the internal proportions of the pennant itself. This matrix cross-references pattern height against pattern width, directly dictating expected yield. There's extreme divergence based on height. In a bull market, tall patterns climb 39% after an upward breakout. Short ones climb just 16%. The structural logic behind this is proportionality. A tall pennant inherently represents greater stored momentum and a more significant volatility compression relative to the preceding steep price trend. Beyond proportion, we must look for a specific structural accelerator on the day the pattern resolves, the breakout gap. This comparison shows a standard continuous breakout alongside a gap opening. Gaps that occur on the breakout day power the stock significantly higher, boosting average performance from 24% to 30%. Combining these positive modifiers creates the optimal trade profile. A tall, wide pattern paired with heavy breakout volume and a gap opening provides the highest statistical yield. All formations do not hold equal value. Quantitative traders must actively grade and score pennants based on this exact geometric criteria. With the highest probability setup identified, we move to capital allocation and trade execution. The absolute rule of engagement here is duration. Pennants are strictly short-term swing trading instruments. They are never buy and hold assets. To prevent front-running the pattern, utilize a strict entry trigger. You must wait for the price to officially close outside the pennant boundary. Once triggered, we use the textbook measure rule to establish a preliminary profit target. Looking at this chart, we measure the vertical distance from the trend's origin at point A straight up to the pennant's start at point B. For step 2, we anchor that exact vector to the intraday low right before the breakout at point C and project it upward to find our theoretical target. You should expect this trade to resolve quickly. Over half of valid pennant setups reach their ultimate trend end in under 2 weeks. The measure rule calculation provides the baseline for sizing the trade, even if it requires subsequent adjustment. We must return to the paradox established at the beginning. The theoretical measure rule frequently overshoots empirical reality. This animation shows the precise divergence. On average, the actual price data tracks a shorter distance and takes longer to get there. The post-breakout move falls short of the pre-breakout trend. Therefore, the measure target must be treated as an absolute maximum ceiling. You must plan for conservative scaling out prior to that theoretical peak. Watch the intraday tape for immediate visual exit triggers, failing momentum, stalling at known overhead resistance zones, or the formation of lower highs. Do not hesitate on the exit. Delays frequently result in selling into a rapid downdraft. Once the upward trend ends, prices drop an average of 25%. The complete quantitative approach is precise. Trade in alignment with the macro trend. Filter for tall patterns with gap breakouts. Calculate the target, and execute your exits conservatively below textbook projections. The technical analysis, trading strategies, and statistical probabilities discussed in this video are for educational and informational purposes only. They do not constitute financial advice. Past performance of specific chart patterns does not guarantee future results. Trading equities involves substantial risk of loss. Technical trading is not about finding perfect shapes. Data-driven discipline, dynamic filtering, and a strict rejection of textbook dogma represent the ultimate edge in the market.